So Warren Buffett, Charlie Munger and Mark Cuban all think I'm an idiot. Yes, you heard that correctly. In an interview which Mark Cuban did most recently, he went on to say,
all that asset management, diversification, that's for idiots.
And even Warren Buffett has been quoted saying why diversification is only required when investors do not understand what they're doing. And even Charlie Munger has been quoted saying the idea of excessive diversification is madness and only guarantees ordinary results. So am I an idiot for investing into things like the S&P 500 index, a collection of individual stocks, as well as a little bit of cryptocurrency too? Well, whilst I'll leave that down to you guys to make your own judgments down in the comment section below, during today's video, what I wanted to discuss with you guys is the pros and cons of diversification within an investment portfolio. We'll talk about the optimal approach to diversification, and I'm also going to share with you guys the actual impacts of diversifying versus not diversifying, so be sure to stick around until the end of the video to get an insight into actually my investment portfolio and what that actually looks like, because it may actually change your overall viewpoints on what diversification means for you and your own investment philosophies. But before we get started, guys, my name is Mitch. I post all kinds of videos on investing and the stock market. If you do enjoy content like that, be sure to hit that big red subscribe button down below as well. Drop a like on the video, guys. Really helps out the channel. With that being said, let's begin. So first up, what actually is diversification within an investment portfolio and why exactly would you do it? Well, as it says over on Investopedia, diversification is a risk management strategy that mixes a wide variety of investments within a portfolio. A diversified portfolio contains a mix of distinct asset types and investment vehicles in an attempt at limiting exposure to any single asset or risk. The rationale behind this technique is that a portfolio constructed of different kinds of assets will, on average, yield higher long-term returns and lower the risk of any individual holding or security. So not having all of your eggs in one basket certainly refers to having sound risk management, lower exposure, as well as a higher potential for reward and return on investment over the course of the long term. So with that in mind, what on earth are these three investing experts on about when they refer to diversification being for idiots? Well, first up, I thought it's probably worthwhile me trying to decipher what I believe the likes of Warren Buffett and Charlie Munger mean when they're actually referring to excessive and wide diversification within an investment portfolio. Because of course, the word diversification is a little bit subjective. Let's talk about a scale of diversification, where on the one end of the spectrum, you have no diversification whatsoever, i.e. you're probably just investing into one single equity, like Tesla as an example, and absolutely going all in. Then we have what I'm going to label up as moderate diversification, where you invest in a select few equities, like Charlie Munger as an example, who has 5 holdings within his own $250 million investment portfolio, which includes the likes of Bank of America, Wells Fargo, Alibaba, US Bancorp, and a very small position in a materials company called POSCO. Then you go up to what I'm going to label as fair diversification, where perhaps you are diversified across a whole market index like the S&P 500 as an example. It's a strategy which Warren Buffett has certainly backed during interviews in which he's done, where he's simply said that for the vast majority of investors, they should simply go on to invest into a low-cost index fund like the S&P 500. Then you have what I'm going to label up as excessive diversification, whereby you have literally so many investments within your investment portfolio, there's no way whatsoever you can be well informed about them all, let alone manage them. It's where the number of investments within your portfolio exceeds the point where the marginal loss of expected return is greater than the marginal benefit of reduced risk. Now what that actually means is, let's say you've got an investment portfolio with 5,000 stocks within it. Actually, at that point in time where you've literally got so many holdings within your investment portfolio, there's actually not really any added benefit from adding another additional stock to that portfolio, because there's no longer any benefit from reducing the risk from doing so. And as a result, as Charlie Munger says, excessive diversification will only ever warrant ordinary results. Which kind of brings me on to the point around why you should not excessively diversify your own investment portfolio. Let's say we selected a fund like the Vanguard FTSE All Cap Index with 5,837 holdings within it. Now, if you wrote down every single individual holding within that fund one by one, and if you researched them all in depth, you would probably find some fantastic companies within the fund itself, like Apple, Microsoft, Amazon, and Tesla. But then by the time we get down to page 583 of the fund's listings, you're left with companies which I've personally never heard of before, like Oncopeptides, however even you pronounce that, Solid Force this feels like I'm speaking another language, and Stone Co Limited. And the reality is these last three investments are probably going to be shit investments. And it just so has it that one of these stocks is actually down 95% in the past year, the other's down 80%, and the other stock doesn't even have a month's worth of stock data, but regardless, it's still down 8% just in the past month. If I put all 5,837 stocks in front of you right now and said you could only pick 15 stocks in order to formulate the best possible investment portfolio, then the chances are you'd probably pick stocks from possibly the first 3 pages of the 583 pages worth of holdings. So with that in mind, it kind of raises a question as to why you'd actually go to the extent of diversifying so much where you have an additional 5,822 holdings within your own investment portfolio, when you could simply just pick out 15 good stocks instead. Because when you're investing into a fund like this where there are so many holdings within it, yes, you get the exposure to lots of good companies within the fund itself, but you also get exposure to some of the bad companies within it too. And yes, of course, you obviously mitigate far more risk from having such a well-diversified investment portfolio across geographical markets, economic sectors, and lots of different stocks within the portfolio itself. But at what point are you actually sacrificing some of your potential upside by having such a broad range of diversification all in a single fund? Well, that's something for you guys to weigh up within your own investment strategy and your own approach to investing, and to try and decide how many stocks you guys feel comfortable with to still get a broad range of diversification within your investment portfolio. So with that in mind, now let's talk about the optimal number of stocks to have within an investment portfolio in order to diversify, but just not excessively. Well, the optimal number is a little bit difficult to provide because there's not actually a definitive answer. Academics and analysts certainly contradict themselves in terms of what they believe is the optimal number of stocks to have within your portfolio. So to give you guys a few examples, we've got some academics saying between 20 and 30, some analysts saying between 20 and 25, other articles saying between 10 and 15, and others are even saying up to 300 stocks within an investment portfolio. But from the research in which I've done, the kind of average, I guess you could say, is between probably 10 and 30 holdings within your own investment portfolio is probably the optimal number to go down based on the law of diminishing returns, which essentially means for every additional stock which you capture within your investment portfolio, it mitigates your stock-specific risk, but it also reduces the additional return of adding an additional stock. So by the time you hit 9 holdings within your investment portfolio, you're 88.9% diversified against stock-specific risk, and by the time you hit 29 shares, you're at 96.7%. So despite adding an additional 20 stocks to your investment portfolio, essentially tripling its size, you're actually only mitigating an additional 7.8% of your risk. And anything above that, well, you kind of not really got much more upside to mitigate any additional risk whatsoever. At that point, you're probably only facing into higher portfolio fees and a hell of a lot more time in which it's going to take you to actively manage your investment portfolio. So if you are individual stock picking, my own personal view is to probably have no more than about 30 stocks within that portfolio. But if you're not quite comfortable picking individual stocks and making your own investment portfolio, then I'd probably go up to a bigger fund like the S&P 500. However, some of these funds which have 5, 6, 7, 8,000 holdings within it probably aren't that much more beneficial. So with that in mind, I thought I'd share with you guys a little bit of a snippet of my own investment portfolio's performance over the course of the past couple of days to show you exactly what the difference is in terms of volatility within an investment portfolio when you're diversified versus when you're not. So as you guys know, I have 2 separate portfolios. I have an old Vanguard ISA account which I used many years ago, and then I have a trading 2-on-2 account which I actively invest in today. And for those of you guys who have been keeping up with the movements of the stock market over the course of the past few days, well, it's been pretty bad with an absolute sea of red all across the board. And as a result, result, as you'd probably expect, my own investment portfolio certainly took a beating. However, one portfolio took far less of a beating in comparison to the other. What I would certainly classify as my well-diversified investment portfolio over on Vanguard, which, if I'm honest, is possibly pushing towards the excessive diversification that Charlie Munger and Warren Buffett certainly think I'd be an idiot for, has actually only dropped in value to the tune of £70.35 since Sunday night, which is certainly not too bad, and it's certainly something that I can take on the chin. However, my less diversified investment portfolio, where I individual stock pick over on trading 2-on-2, is down quite a bit more than that. In actual fact, over the same time period, we're down from a gain of £6,174 on Sunday to now just £5,623 as of now, a difference of a loss of £551. In terms of a percentage change, that's a minus 0.37% change over on Vanguard compared to an 8.87% change over on trading 2-on-2, which I think is a really important point to make. Less diversification within an investment portfolio can certainly lead to a hell of a lot more volatility, and Charlie Munger can vouch for that firsthand if you look at his Alibaba position over the course of the past 12 months. And I think it is an important point to make because it's possibly an element of overall investment strategy that we don't really talk about too much, because we're only really focused on risk and reward within the investment portfolio, and we talk a little bit less about volatility within it. So the question that you should probably ask yourself is, how much tolerance do you have for both drawdown and volatility within your investment portfolio? The lower your tolerance, you'll probably feel a little bit more comfortable higher up on that diversification spectrum, despite the fact and regardless of whether Charlie Munger thinks you're an idiot or not. At the end of the day, you have to do what's right for you and your own personal approach to investing. So with that said, guys, if you do want to learn a little bit more about investing, be sure to click on this video here. And if you did enjoy this video, guys, be sure to drop a like on it, subscribe to the channel if you're new around here. With that being said, I'll see you over in the next video.